tenemos ahora con nosotros a Alliance Bernstein, concretamente a Henry Smith, que es Investment Strategist Multi-Asset Solutions en Alliance Bernstein. Henry, good afternoon. Thank you so much for this interview in Negocios Televisión. With a slowdown, Henry, in inflation normalization so far this year, particularly in the United States, how has your macroeconomic outlook evolved?
Sure. So I guess earlier this year, coming out of a generally strong 2023 for global economic data, and given fairly rapid easing in inflation, we expected to see a slowdown in economic growth this year, along with further normalization of inflation towards central bank targets, and then the start of interest rate cuts. And as you sort of note, this year hasn't exactly panned out as expected. The most obvious challenge has been inflation, which has been much stickier than we would like it to be. And the US is one of those markets that has been most challenged in this regard. So if we think about the various different CPI prints that we have had out of the US so far this year, until the most recent print in April, which was in line with expectations, every single one that we had so far this year came in above consensus forecasts. And so that said, while inflation progress has been disappointing this year, we don't see the inflation normalization process as actually being completely derailed. We continue to expect inflation to fall, but we think that the path will be somewhat bumpy. And our forecasts for the next few quarters envision inflation at or approaching central bank targets in many regions, but the US is likely to be a laggard. And the sort of speed of progress will vary over time, and it will vary across regions, and that will likely cause some friction and likely result in market volatility. Beyond inflation, the other place that we've seen some sort of upside surprise so far this year has been in the continued strength of the global economic environment, despite the headwinds of higher interest rates globally. And our base case going forward is still for a soft landing of the global economy. So that is inflation eventually coming under control without a meaningful recession. And current economic data supports this view that global growth may fall only very modestly below potential. But again, we're likely to see dispersion among regions. US growth is likely to fall slightly below trend, while Europe and the UK, driven by a recovery in domestic demand, looks likely to recover from mild recessions as the year progresses. The one place that's a little bit different, I think, is emerging markets, which is somewhat of a different story. They're further along in the rate cutting cycle, and monetary policy is already easing and supporting growth in that region.
What does this outlook mean for central bank policy and global interest rates?
So the slowing of inflation progress this year, paired with the global economy generally holding up well, has meant that central banks have held fire on commencing interest rate cuts. While we thought at the start of this year that maybe markets were pricing in overly aggressive rate cuts for the year ahead, even if we start with a more conservative outlook such as ours, we have seen this year fairly consistent and significant shifts in interest rate expectations towards higher levels for longer, and that's something that we continue to monitor. In terms of looking ahead, we do expect central banks to begin cutting in the coming months, even if inflation isn't falling in a straight line. And sort of up first, we see the European Central Bank, and then maybe the Bank of England's kicking off rate cuts this summer, as inflation within those regions hovers around targets, and given the sort of relative weakness of trailing economic activity within those regions. And then following on from that, we expect other major economies, including the US, to join later this year, gradually cutting rates into and throughout 2025. But in terms of central banks' actions and messaging, I think it's important to point out that the next move is likely to be interest rate cuts. The only real question is sort of when is most appropriate, and that we don't see, and central banks have commented that they don't see additional hikes on the horizon. And this is quite a critical viewpoint, because as long as markets stay confident in this fact, the exact timing of rate cuts is likely to be less important. Now, so don't get me wrong, sooner rate cuts would be better for markets generally, but as long as the next move is easing, financial markets are unlikely to suffer too severely.
Given that backdrop, how should investors think about their exposure to stocks and bonds? Is there a clear preference for one over the other?
Sure, it's a great question. So we have seen a material divergence between the fortunes of stocks and bonds so far in 2024. After both asset classes moved in tandem somewhat last year, that sort of shift in interest rate expectations that we've seen so far in 2024 has driven a wedge between these two asset classes. So when we think about returns through to the end of May so far this year, global stocks are up over 11% in euro terms, while the sort of global aggregate of bonds is down over 1%. So that might suggest that stocks are the clear winner, but we actually think the case going forward is much less clear cut. Given that sort of outlook that I outlined before, that sort of combines slow but positive economic growth, continued progress against inflation, and easing interest rates, we believe that that environment is much more conducive to return to both across both stocks and bonds. On the one hand, and kind of obviously, stocks provide that direct exposure to economic upside and some of the strong corporate earnings that we have seen. And once some of the headwinds that are really affecting bonds in terms of inflation and interest rates start to fade, these are left with some very attractive levels of yield. And then as a kind of bonus, while correlations between these two asset classes haven't been that attractive for some time now, we expect inflation normalization to actually improve the diversification benefit of holding both of these asset classes at the same time. But I think it's an important caveat just to that statement around bonds is just to reiterate that with the corporate bonds are generally looking less attractive at the moment, especially if we consider the yields that are available from sovereign debt, and if we consider corporate credit relative to the strong potential upside of investing in stocks. The only place where maybe that is a little bit different is for investors seeking income, however. In that case, there is potentially a case to be made for corporate bonds, but generally more at the higher quality end of the spectrum. But sort of as always, given that my sort of multi-asset hat, I think it's important to keep both sets of these exposures, your exposures to stocks and your exposures to bonds, under constant review. So market conditions and volatility can evolve very quickly. I think this year has reminded us of this fact. And so we advocate a dynamic investment approach that can take into account any changes in the market risk and return environment and then react accordingly.
What other opportunities and exposures should investors consider in this environment, Henry?
Yeah, so one area that we're watching quite closely is emerging markets. If you think about the sort of macro level picture for emerging markets, growth has been very resilient, considering the headwinds of higher interest rates across the globe, of a generally strong US dollar, and then a slowdown in China. In fact, our economists have upgraded their growth forecasts for emerging markets over recent months on the back of strong momentum in India. Just as a reminder, this is a market that has grown very quickly in recent periods. It has been a hotspot for technology innovation, and it benefits from very supportive demographics. And then I guess additionally, as I mentioned earlier, emerging markets are also further along in the cycle and have actually begun easing monetary policy. And all of this is happening at the same time as emerging market valuations looking relatively attractive compared to developed markets. Of course, that paints a very positive picture. I think it's important to note that we should be mindful of some key risks of emerging markets, such as geopolitical risks. We've got the conflict in the Middle East, and then you've also got the hot topic of US-China relations. And then you've also got the potential impact of higher US interest rates for longer, sort of weighing on the region more broadly. The other place that we've seen quite a bit of opportunity is beyond simple exposure to emerging markets and actually accessing active management expertise within the region. So we have generally seen an ability for active managers to deliver meaningful excess returns when selecting securities within emerging markets through a combination of sort of deep research and strong portfolio management alpha. Just to sort of demonstrate this, for example, the average EM equity manager within the respective Morningstar universe has actually outperformed a passive equity benchmark over several time periods, both the sort of longer term and the shorter term. And so as a sort of result of this, one thing that we've been doing is we've been reassessing our sort of active management budget within our portfolios and potentially tilting that a little bit more towards emerging markets as a region. The sort of second area of opportunity beyond emerging markets that I'd highlight is exposure to long-term growth themes. So while we expect the global economy to achieve positive growth, this is expected to actually be fairly slow by historical standards. So to continue to deliver attractive returns in investment markets, we need to be thinking about aligning ourselves with areas of growth within the global economy. And there are several sort of key growth themes that we think can do that. One of those areas is themes associated with sustainability, and we see a lot of very compelling growth rates there today. So if we take sectors such as electric vehicles, such as sort of artificial intelligence, and such as DNA sequencing, we are seeing attractive annualized growth rates for these sectors above 20% per annum.
Last question, Henry. Beyond the path of inflation and interest rate policy, is there anything on the horizon that you're monitoring closely?
Sure. So I think this is one that's talked about quite a bit, but one thing we're definitely watching is geopolitics. Most front of mind, we now have various ongoing conflicts around the world, including within Europe and within the Middle East. Clearly, should there be some form of material escalation in those conflicts, we would need to quickly react and reduce risk in our portfolios and lean further into some of the portfolio diversifiers and hedges that we currently have in place. I'm thinking of particular exposures such as commodities and energy producers, which are areas that we would expect to benefit from further escalation in these conflicts. And then I guess also a preference for some safe haven and commodity sensitive currencies. The other area of geopolitics I think is important is elections. 2024 is set to be a very big year for elections. In fact, when we look at the numbers, it is potentially the biggest election year in history, with over 40 different countries going to the polls this year, generally representing around half of the world's population. The one coming up later this year that will receive particular attention from markets is the US election. I think it's important to reflect on market returns, and generally our experience has shown that market returns around elections generally aren't too different to non-election years. What we do see, however, is the potential for additional near-term volatility around key election milestones. And so that's one thing that we believe investors should be watching quite closely. And then obviously beyond that is thinking about the longer term impact of any lead policies that are expected to be implemented by election winners. In particular, one thing to be cautious of is anything that might impact budget deficits going forward, given the generally elevated levels of government debt that have been built up since the pandemic.
Henry Smith, investment strategist, multi-asset solutions at Alliance Bernstein. It's been a pleasure to have you here. Thank you so much for joining.
Thanks, it's been a pleasure.